everyone. Thank you so much for joining me. My name is Kay Thompson, and this is A Lesson in Real Estate. For today's lesson, I thought that we would talk about something that I really haven't touched on much in previous episodes. I've mentioned it, I think, here and there, but because we're in a new year now, and I know that the time is fast approaching for people to have, some extra funds in their wallets, due to, people getting their income taxes and things of that nature. I thought I would take a little bit of time and share with you some ways that you can use that money smartly. Now, of course, one of the best, in my opinion, actually, the best investment that you can make is in that of real property, because even though the markets go up and down for real property or real estate, the price is never zero. You can always buy or sell real estate for some money. It always has value. And so to me, it is just a perfect vehicle to, begin to build your wealth with. Now, most people, when they think about real estate, they think about buying or selling their own home. And a lot of us here in the last, I would say, decade, we've kind of started to pay attention to the fact that you can invest in real estate, and invest in buying and holding real estate, or and doing other things as far as investments when it comes to real estate, fairly easy. A lot of you have probably seen, seminars and things of that nature that come to your town that promise you, hey, we'll be able to help you to, become a real estate investor by, using a specific method, not using your own money, these kinds of things. Now, I want to say that that is absolutely possible, that you can invest in, buy real estate without using your own money. Those tips and tricks for doing that, though, is there's just so many different ways you can do it. It's enough to fill up 3 or 4 other episodes. And so we'll cover those at a later date. Today, I wanted to discuss, though, one simple way to get into real estate as an investor, and it's a way that a lot of people don't really talk about. And so, like I said, because so much exposure has been given to fixing and flipping, and buying and holding, and also another way of investing, which is called contract assignments or wholesaling, I thought that I would focus on today, like I said, a different type of investing that most people don't think about. And that is to be an investor in mortgage notes. And so a lot of people probably don't understand what a mortgage note is. So a mortgage note is just the paper that provides you, when you get your take out your loan for a home, and you're paying a lender. The mortgage note is the documentation that will provide you with the details regarding your loan. It's going to tell you how much money you owe, what the interest rate of the mortgage is. It's going to tell you the dates when the payments are due, the length of time for repayment, and where those payments are to be sent. And so that's what a mortgage note is. It's, in other words, it's kind of like a promissory note. So when you buy a car, you sign a promissory note. And the main difference between the two is that the mortgage note is a promissory note that's a written agreement containing the details of your mortgage loan, and what property is secured by that note. A promissory note doesn't necessarily provide all of those details to you. Like an IOU can be considered a promissory note, just someone promising to pay back a certain amount at a certain time. It doesn't detail all the intricacies of the loan like a mortgage note does. And so you're probably wondering, if someone already has a mortgage payment, they already have a lender, how can I invest in that? How is that profitable, or how could that be profitable for me? So we'll talk about that in a few minutes. First, I wanted to tell you that there are two types of notes. So you have performing mortgage notes, and then you have non-performing mortgage notes, and they're both typically notes that you can buy. So a performing note is a mortgage loan in which the borrower is paying the mortgage or making the payments as is outlined in the promissory or mortgage note, not promissory, but the mortgage note. So if your mortgage note says your mortgage payment is $500, it's available and it's due on the first of the month, and you're paying that payment every month for 30 years, and you're paying those payments on time, that $500 by the first, then you are actually performing as expected according to the terms of the note. And so your note itself is what they call a performing note. That means that you are meeting the obligations as is outlined by the documentation outlining the payment. And then, of course, a non-performing note is the absolute opposite. It is a mortgage note in which the borrower is not paying as is outlined in the terms of the note. So the borrower may be paying partial payments, or they may not be paying at all. They may be paying principal only and not covering the interest. They may be, maybe part of the terms of their loan is that they cover the taxes and insurance and for the property, and they're not doing that. So there's something about the note that the buyer or actual note holder, the borrower, is not keeping their obligation for. And so those are the two main differences in them. And so you can buy these notes, usually non-performing notes, you can get at a little bit of a discount because your goal is going to be to figure out how to get, how to get the note performing again. A lot of times you can work, there's people in the industry that can help you. So, you can talk to the mortgage lender or the mortgage holder to see exactly what the details are, what's going on with the note, what has the, borrower said to them, as far as their reasoning for not being able to perform according to the terms of the mortgage note. You also should do research. So one of the biggest things that I've noticed in the last I would say decade and a half, is that investors have gotten very comfortable with, buying properties sight unseen. And that's okay if you're a well-seasoned investor who really, really knows what they're doing. But if you're someone that's new to investing, I would strongly suggest that you don't buy properties that you have not seen. You want to make sure, especially with a mortgage note, because you're really just buying the promissory note or the note. I say it's a promissory note because they're very similar, but you're really just buying the paper, the mortgage terms. And what's happening is, how you make money from that is when the buyer or the borrower for the loan makes their payment, you're getting either all of or a percentage of the interest that is coming off of that mortgage. So if someone is paying $500 a month and $100 of that $500 payment is to be applied to interest, as the mortgage holder, you would be making that $100. Now, there are ways that you can buy notes all on your own. There are ways that you can purchase notes in conjunction with other people. So kind of like crowdfunding, if you understand what crowdfunding is. That's where lots of people pool their resources together to purchase an asset. And once that asset is producing income or revenues or profits or however you want to say it, those people partake evenly or evenly in the reaping the benefits of what the profit was, or they're going to reap benefits based on the terms that they agreed to in their own original agreement. So you may have, 10 people that are supposed to make something off of this $100 interest payment that I spoke about earlier. One person may be getting 1%. So that means he's only going to get $1 of the $100. Somebody may be getting 20%. So that means they're going to get $20 of the $100, and so forth and so on. So that is really what mortgage investing is. It is an investor coming along and saying to a bank or the holder of a mortgage note, hey, I'd like to pay you so much to become the owner of this note. And then once you've done that, you immediately begin, especially if it's a performing note, meaning the buyer or the borrower is paying their note according to the terms that are set forth in the note. So if the buyer is making their payments as they should, then you have a performing note, and that means that you can count on those monies or that interest being there available and being paid to you every month for the duration of that loan, or until you decide to sell the note or your portion of it, depending on how you bought into it. The same is the case for non-performing notes, but you do have to do a little back work, a little, leg work. Usually you're going to have to, especially if you're buying the note and you're working it out with the buyer or the borrower who's behind. You're probably going to have to do some creative things to get the note caught up before the mortgage lender will, decide to let you in on the deal on the deal as to be able to collect, resources from it, because they're, willing to sell you the note. So there's lots of different ways that you can get into, the business of buying and selling mortgage notes. I strongly suggest, though, that you go and you do your own research. Do research on the property. Make sure that if you're new to investing, that you're trying to buy properties or invest in notes where they're local to you, so that you can actually go by the property and make sure that what you're buying is actually what's there. I would strongly caution you, though, against going up into the yards of people if the properties seem to be occupied and things of that nature, because you don't want to be trespassing. And even if you're there to potentially buy a mortgage note, the buyer or the borrower of the note may not be aware of that. Depending on how you came across the note being for sale, and you really just don't want to have a situation where you're into it with someone because they don't know the whole story behind what you're doing. The other thing that I would suggest is that you check the public assessors, your property assessors, check records. Make sure that the mortgage company or whomever you're buying the note from was doing the right things. Make sure some mortgage companies, will set up escrow accounts for their buyers, and they collect taxes and insurance from them, as a part of their mortgage payment. And then those funds are, then sent over to the powers that be, the insurance carrier, the property tax assessor, whomever. And then there are some mortgage notes that are set up where there is no escrow account. So the buyer is responsible for turning in and making payments for taxes and insurance and that kind of thing. So before you accept a mortgage note as a purchase, you want to read the terms and conditions, and you want to see how those things are set up. If it's something that you're responsible or that the borrower is responsible for doing on their own, then I would probably stay away from that one. If I was new to mortgage note investing, because in most cases, income, property tax or federal tax liens, taxes in general supersede any other lien. So it may not be the case in every state, but I'm pretty confident that it's the case in most states. And so you don't want to buy a property that is already having tax issues and liens of that nature, and you're not aware of how to lift that burden from the property. That might be something that you will want to leave alone. The other thing is that you want to be careful of is to understand the numbers. Make sure that you understand what you stand to make if you were to purchase the note. How is the interest set up? How are the interest payments paid? Where can you have those paid to? Because that's also important. You need to know where your money is coming from, how often it comes, and in what manner will you be receiving it. And so those are just some of the things that you can do to keep yourself safe. If there is a local real estate investors association in your area or area, I would strongly suggest going to one of those meetings that local and talking to someone there. If you have other questions, of course, you guys know, as I've said it a million times, one of my favorite places to gather information about anything financial is Investopedia. So you could definitely go to Investopedia and find out information about, mortgage notes, more in-depth information on what they are and how they work and things of that nature. So finally, I wanted to get to the benefits, some benefits and advantages of becoming an investor in mortgage notes. Number one, you don't need a lot of money to get started. There are two internet-based companies that you can go to get started. One of them is called paperstack.com. The other one is called crowdstreet.com. They both allow for mortgage note investing. And they make it really easy for you too. You can go to those sites and look at some of the properties that they have available. And they'll give you all the details that you need to know about the properties before you invest in them. And then, it's just really a safe way to go if you don't really know a lot about how to go out and find those kinds of properties yourself. And there's tons of other ways to get to that, kind of information. There is some great information on YouTube and great mortgage buying, videos and information on YouTube. So that's another good place that you can go to search out real estate investors who are investing in notes. And so that's the main reason. You don't really need a lot of money to get started. You can buy into some mortgage notes for as little as a few dollars. The second thing is you don't have to be a landlord in order to invest in mortgage notes. You have no obligation to maintain the condition of the property. That is still up to the borrower, the person who took out the loan, to do. So they will be responsible for any repairs. They will be responsible for any upgrades and any upkeep, just like a traditional homeowner would be. So you never have to worry about doing any of that kind of stuff. One of the other things is that the income is truly passive. So it's truly income that you can collect once a month, twice a month, whatever, depending on how the borrower pays their mortgage. And that money can just be added to your bottom line, because again, what you're operating on and working from is the interest. The buyer or buyer of the property is going to make their mortgage payment, and then you are going to collect interest from that. And so that is another advantage. There's a bunch of other reasons why it's, great to invest in mortgage notes. Here's one reason that it's great to invest in mortgage notes over and above, say, stock, because the mortgage note has collateral attached. Whereas the stock market, you're investing in the stock market, you're taking a risk, but there is no collateral attached. So if the stock tanks, you just lose your money. With mortgage note investing, if the buyer decides, hey, I'm just not gonna, pay any more money, I'm not gonna do anything, then you absolutely have the right, depending on what's written in the mortgage note itself, to call the note due. In a way in which most mortgage companies have some sort of escalation clause in there that says, hey, if the buyer defaults, then we're able to reclaim and get control of the property again. So that's definitely one of the a big benefit. Another benefit is that, you can control how many properties you're involved with as far as the mortgage notes, and control that. So with managing real property as a landlord, for example, you're going from house to house, and depending on what your setup is, you're having to worry about collecting rents. You have to worry about, tickets and, tickets from repairs and things of that nature, and keeping all of that together. You have to have, a good landlord would have a crew on staff, that could make repairs pretty easily, at least a plumber, an electrician, maybe a yard guy. People who can come through, not an electrician, but an HVAC guy. People who can come through and, get things done for you fairly quickly with regards to maintaining the property. And so you don't have to do that with this. You can own, parts of hundreds or even thousands of mortgage notes. And all you have to do is count the dollars as they come in. You don't have to, be a property manager, or, if the buyer is going to be late paying the mortgage, you don't even really have to listen to that. I mean, so it's a great way to create a passive income that can just grow over time, and just help you evolve into a bigger and better investor. You could take those profits from the interest payments that you're getting and eventually invest in another property to fix and flip. You could save those funds in a retirement account or in a Roth IRA to send your kids to school. So all of those things can come about because of mortgage note investing. I think that it is something that more people should look at. I think it's something that people should look at, especially if they don't have a lot of money to start. And I just, encourage everyone to educate themselves about the topic before they go out and invest. If you're not sure about having a RIA or a real estate investors group in your area, please reach out to a local real estate professional, a realtor, realtist, real estate agent, and they'll be able to help guide you and put you on the right path to becoming a mortgage note investor. By all means, you can reach out to me. My phone number is running across the bottom of the screen. You can also go to PaperStack or CrowdStreet and read this information, or read information about how to get started yourself. So with that being said, I'd like to thank you so much for joining me. I hope I gave you some information that you can, take in this new year and, really put some positive changes into your life with. And I am very ecstatic that we're moving on to the next phase in our programming. We are going to start doing more to discuss with people ways that they can invest their monies in real estate and make our neighborhoods and communities safer and better for everyone. So until next time, take care of yourself and stay safe out there. Bye.